Alphabet incorporated $190 billion risk. Is this brilliant strategy or blunder? Alphabet Incorporated's $190 billion AI risk urges business leaders to build smarter ROI strategy and secure AI value. Alphabet is entering second quarter 2026 earnings under intense pressure because its planned $180 billion to $190 billion AI capital expenditure must now prove it can generate sustainable profits instead of simply showcasing technological ambition. The company has already secured approximately $84.75 billion through equity financing and nearly $40 billion in new debt, making AI investment a balance sheet strategy rather than only a technology strategy. You should pay close attention because Alphabet's earnings have become a global benchmark, showing whether massive AI infrastructure spending can consistently create stronger cash flow, enterprise demand, and shareholder value. Alphabet's first quarter results looked exceptional, with revenue climbing 22% to $109.9 billion, proving AI demand remains strong, but investors now expect equally impressive financial returns from future spending. Search revenue surged 19% to $60.4 billion, while Google Cloud expanded 63% to $20 billion, demonstrating that AI-powered services continue attracting enterprise customers despite fierce market competition. Operating margins improved dramatically from 17.8% to 32.9%, while paid subscriptions reached 350 million and Gemini Enterprise paid seats increased 40% quarter-over-quarter, highlighting impressive commercial momentum. Reuters estimates leading hyperscalers may invest around $534 billion in additional AI infrastructure by 2027, while generating only $340 billion in extra operating cash flow, creating a serious capital efficiency challenge. That means companies could spend nearly $1.57 in fresh capital for every $1 of additional operating cash flow, forcing investors to prioritize free cash flow over revenue growth alone. Alphabet is betting heavily on proprietary infrastructure with its 8th-generation Ironwood TPU, the reported Frozen V2 AI accelerator, and specialized cloud hardware powering advanced Gemini workloads for enterprise customers. Wall Street expects approximately $117 billion in second quarter revenue, around $2.87 earnings per share, and nearly 63% Google Cloud growth, leaving very little room for operational disappointment. You cannot ignore execution risks because delays involving Gemini Pro 3.5, Ironwood TPU deployment, or enterprise AI adoption could quickly weaken investor confidence despite Alphabet's remarkable technological leadership. L-Impact Solutions believes the real issue is not spending $180 to $190 billion, but proving those investments consistently generate stronger returns on invested capital while protecting long-term shareholder value. Even after delivering 22% revenue growth, 63% cloud expansion, 350 million paid subscriptions, and 40% Gemini Enterprise seat growth, Alphabet's first quarter free cash flow still declined approximately 47% year-over-year. You should remember that financial markets reward measurable productivity, not impressive AI announcements, because sustainable cash generation ultimately determines whether massive technology investments deserve premium market valuations. Microsoft reportedly reached an estimated $37 billion AI annual revenue run rate. Amazon Web Services continues growing around 28%, while Google Cloud targets roughly 63 to 64% growth amid intense competitive pressure. L-Impact Solutions recommends establishing enterprise AI governance before approving major investments by defining measurable ROI, operating margin targets, revenue milestones, productivity improvements, adoption rates, and quarterly financial reviews. You should invest gradually by allocating only 10 to 15% of your AI budget to pilots, expanding toward 25 to 35% after proven commercial success, then committing the remaining 50 to 60% only after measurable returns. L-Impact Solutions also encourages creating an AI investment committee that unites finance, technology, operations, legal, cybersecurity, procurement, and enterprise risk management to strengthen governance and capital allocation. Infrastructure optimization deserves board-level attention because Google Cloud's operating margins improved from 17.8% to 32.9%, while reducing AI computational costs by just 10 to 20%, can create substantial annual operating savings. You should measure AI success through customer retention, annual recurring revenue, subscription expansion, operating margin growth, infrastructure utilization, and free cash flow instead of celebrating benchmark scores or parameter counts. L-Impact Solutions advises conducting quarterly scenario planning covering semiconductor shortages, electricity inflation, cloud concentration risks, cybersecurity incidents, AI regulations, pricing pressure, and deployment delays before problems escalate. Organizations should continuously monitor capital expenditure against operating cash flow, debt capacity, liquidity, infrastructure utilization, return on invested capital, and payback periods because disciplined governance protects long-term financial resilience. Independent research suggests only around 11% of S&P 500 companies have deeply integrated AI into core operations, showing that workforce capability still lags behind rapid technology advancement. You should strengthen resilience through multi-cloud strategies, diversified semiconductor sourcing, backup inference capacity, executive AI literacy, and annual independent investment reviews to reduce operational and financial risks before disruption strikes. L-Impact Solutions concludes that companies converting AI investments into stronger productivity, expanding operating margins, resilient free cash flow, and sustainable enterprise value will outperform competitors as the AI economy rapidly matures. Can your AI bill grow faster than your AI profits? Comment your answer below. For more strategic analyses, visit our business consultancy website. The link in description below. Thank you.